Today we're going to talk about the Federal Reserve and how they've raised the rates for the 9th time. More specifically, who are the losers and who are the winners going to be from the federal funds increases and where's it heading in 2023? And make sure you stay till the end because I'm going to talk about why I still believe it's going to last for a while. So a great graphic is the Federal Open Market Committee's member projections for the appropriate target level of the federal funds rate at the end of each specific year, going from 2022 all the way to 2025. And each dot represents a committee member. Prior to this week, the federal funds rate was 4.5 to 4 3/4. This week, they raised it again amidst all the banking issues, another quarter point, which now brings it to 4.75 to 5%. What I want everyone to understand is that in each committee meeting, they've raised rates unanimously 9 times without any contention. And since this represents all of 2023, as you can see here, what I really want you to focus on are the members' projections for 2023, because all of them believe that rates need to continue to go up even more to combat inflation to hit the Federal Reserve's target of 2% inflation, which is now well over 6%. So why do I put a chart up like this? Because the Federal Reserve's own committee members' projections are that they're going to continue to have to bring interest rates up even more in 2023, and you should not expect rate cuts in 2023. So the Federal Reserve is between a rock and a hard place because inflation affects everyone, and everyone is in trouble right now with the rising prices. Rising interest rates slow the economy down, which is exactly what the Federal Reserve's trying to do as they try to lower inflation, which helps everyone. Put on your seatbelt, folks, because you're going to continue to see rate increases through 2023 until the inflation rate comes further down to the 2% target that the Federal Reserve has publicly said to everyone that it's trying to accomplish. But for this video, I want to focus on who are going to be the losers and who are going to be the winners. The first thing is if you're sitting in a lot of cash or you're a saver, you're definitely going to benefit. Make sure that you're taking advantage of some of these banks that are offering 3, 4, and even 5% savings rates to try to get your deposits. But of course, you got to be careful which bank you're putting your deposits in, especially with what just happened in the last couple of weeks. The second winner is going to be the lenders that have variable rate debt, not fixed debt, because that is exactly what got a lot of these banks in trouble. As these interest rates have gone up, it's benefited lenders that have variable rates, but it's also hurt the borrowers of those exact same loans. Bonds are also a good thing to get into right now because the bond market is somewhere between 3.5% and 4.5%, depending on when you buy them. The rising bond market is exactly how some of these banks got in trouble because they bought the bonds when they were cheap. Now they're higher. And when the depositors wanted their money back, they had to cash in those bonds and take the losses, which they didn't have. Now the dollar, that's a little more controversial because some people are going to say, we're printing all these dollars, it's making the dollar go down. And if you look at the DXY, which is the indicator for the dollar, you're going to see that that's true. But historically, as interest rates have gone up, it's actually strengthened the dollar. So this is something to watch, not just in the short term, but in the long term. And I believe that the government is trying to make a stronger dollar. The other side of that, of course, is it hurts exporters because U.S. companies' products are more expensive to the entire world. Now, I put inflation here as a winner, even though it's over 6%, but this is exactly what the Fed's trying to do. And we're hoping that it will tamper and lower inflation for everyone because it's creating havoc for people day-to-day living. On the loser side, we should definitely continue to see lower auto sales, lower real estate sales. People with credit cards are now over 20%. I've heard as high as 30% for credit card debt. And of course, the home equity line of credits that are typically variable are also going to be higher, as you would expect, are primarily around borrowing costs. As the cost of interest goes up or the borrowing costs, spending goes down in these categories, or they hurt people that already have variable loans. So we should see a continued drop in sales for autos, a continued erosion in the real estate market, as we're already seeing across most of the United States. Credit card debt will continue to go up because That's a variable rate, and people who have credit card debt are now going to be paying more for the exact amount of debt that they had before because the rates have gone up. The home equity line of credits are also variable, and we're seeing these now over 7% when they just a year ago, they were somewhere in the mid threes. Mortgage rates, even though we've seen them go down just in the last week, are going to continue to be a problem as people try to buy a home. It's going to push them more into rental housing, creating more of a demand in that area. So in the first chart, I showed you that the Fed committee themselves believe that they're going to continue to have to raise rates into 2023. And I really like this headline, which is the Fed is giving Americans a harsh lesson in lag time. And you guys all know that I've talked a lot about lag, where you drop a pebble in the water and the precessional rings take a while to get out to the edge of the lake. This is what's happening right now with interest rates. And it's summarized best in this one short statement about monetary policy. It says, monetary policy takes time to work through the economy. Some estimates say that it could take about a year or might even need up to 3 years to have much impact on inflation. After all, wages are often dictated by contracts, and rents are set for a year or more in advance. Raising rates increases the cost of borrowing, which reduces investment, which is what the Fed's trying to do, slows hiring and wage growth, which is also what the Fed's trying to do, and eventually increases unemployment before inflation comes down. It's far from an exact science, but that is the theory. So what we're just seeing now is just a little bit of inflation going down, but we are not seeing unemployment go up like they had hoped. So this quarter point increase was not surprising to me, and the fact that the Federal Reserve still believes that they need to raise rates through 2023 is certainly no surprise. So in the chart down below here is a 5-year chart of the federal funds rate. And as you can see, somewhere in about March or April of 2022, the Federal Reserve first started to increase rates. Of course, that's only 12 months ago, and the chart to the right shows how it's increasing and where we are today. Most economists believe that it's 1 to 3 years before these rising rates start to impact the economy and lower inflation the way that the Federal Reserve wants. What's mostly important to note here is that right around here, inflation was at 9.1% in June of 2022. As you can see, the Federal Reserve continued to raise the federal funds rate during this period of time, and of all of those raises, it's still at 6.4% today. So this truly is a lesson in lag, and we are definitely going to see a slowing economy in 2023, and we might even see more in 2024. So this is the year for you to build up cash and get ready for when prices actually start to really significantly lower, because I don't really believe we've seen anything yet. For those of you who are trying to figure out where all this is heading, you can join us at Limitless this year on June 15th to the 17th in Scottsdale. For Limitless, just go to limitlessexpo.com. And I actually have Joseph Wang, who used to work at the Federal Reserve, who's going to be talking about this. He has a book called Central Banking 101, and he's going to explain this in more detail, but more importantly, hopefully, tell us where all this crazy nonsense is heading so that we can better make decisions in our purchasing and acquisitions in late 2023 and hopefully 2024.